Hey everybody, it's Daniel here from InfoRest. Hope you're all doing well. So we got some jobs numbers coming out today and the market's reacting accordingly. So what's going on here at 10:50 a.m.? So first things first, we got the non-farm payrolls report, which is the government's data that goes over basically how the job market is doing. So the non-farm payrolls report came in weaker than expected. However, previous number in the previous report was revised higher to 307 from 256, so that was an improvement. And we also saw the unemployment rate dip down to 4% from 4.1, so not bad there. Positive, number for the unemployment rate. The headline number, the 143K versus 169, a little bit negative there. But what was shocking here, and this could be a one-off, but the average hourly earnings, so the year-over-year number came out at 4.1%, and the month-over-month number came in at 0.5%. So this is higher than the expectation, right? The expectation for the month-over-month was 0.3, and we got 0.5. And the year-over-year expectation was 3.8, and we got 4.1 coming out, right? So a little bit higher than expected. Now, how did the markets react to this? Well, we got the bond market and the stock market to initially rally on the weak non-farm payrolls, the headline number, the 143K. But then after we saw some selling in because of the average hourly earnings, right? Because that basically hints towards sticky prices, higher inflation, thus what's the odds of getting those rate cuts anytime soon basically diminishes it further, right? So we're seeing the central banks around the world cutting rates and being more dovish than the Fed, and this number itself basically points towards there's less likelihood of the Fed going out and trying to be aggressive like the other central banks out there in terms of cutting rates. So it gives them more of a reason to slow down and pause and assess the situation here. So that number came out. Along with that number, we also got the Canadian employment numbers. That also came out better than expected. The unemployment rate, which we track quite heavily here, came out 6.6%, better than the expected of 6.8, and better than the previous report, which was 6.7. So quite the drop there on the unemployment rate. The employment change numbers also came in higher, 76K versus 25K. However, the previous number was revised lower, massively lower. Okay, the previous number was 179K, and they had to revise it and change it. No, that number was wrong, not 179K. It's actually 91K. So what a drop in its previous number, basically stating that they were massively off on the previous employment numbers. The full-time employment change came in at 35K. The part-time came in at 40K. And when we look at the previous numbers again, right? Here's the kicker. Part of that massive revision down in the previous report had to do with employment, full-time employment change. Okay, that number from 171K, that was the previous number that was reported in the last report. That number dropped to all the way 59K. So they told you that the jobs, the full-time jobs that were added in the last report was 171,000, and they just came out today saying, oh, sorry, oopsie daisy, we are way off by more than 100K, and we actually have to change that to 59K. Okay, so massive drop in the full-time employment, telling you there's weakness when it comes to full-time jobs. In terms of especially hiring, less people are hiring, and you can see it in the full-time employment numbers. Now, the part-time, if you're not getting a job or you're unable to get a job, then what do? you try to find some part-time work, right? The part-time numbers for the previous report actually went up, revised higher, from 7.1K to 31K. Okay, this is like, red flags everywhere, right? For the Canadian employment numbers. So we're talking about, again, massive drop in the full-time, huge pickup in the part-time from 7.1K part-time, they told you, to 31K, right? Big jump. So other than that, right, the current report that's telling you 76K, guess what? Let's see next month, right? Does that number get revised lower, right? They're telling us 76K right now. Is that right or is that wrong? We'll find out in the next report, right? Because clearly the previous report, they were massively off on the employment numbers, and they were massively off on the full-time employment, revising it down, and also changing their part-time, basically telling you that people are losing jobs, they're not unable to get a job, and they're looking for more part-time in the Canadian employment situation there. Now, although today's report is telling you, okay, things are better, we expected 25K, but we got 76K, and guess what? The unemployment rate dipped down to 6.6%. So that is yet to be seen in terms of how truthful those numbers are, and we'll know in the next report, right? So overall, the U.S. and the Canadian employment rate, if you look at it as a whole, looks not bad. Canadian, not bad report. The U.S. report, it's okay, a little bit weakness in the headline number. But what we don't like here is the higher average hourly earnings, which basically hints towards stickiness and inflation, and has also hints towards less chance of those rate cuts. Now, the stock market brushed that number off and started to go up, and after the 9:30 a.m. open, we saw the markets, the tech and the S&P 500 move up higher, and then we got the Michigan numbers, and the Michigan numbers basically caused the markets, as we're seeing it today, all the equity indices, the Dow, the Russell, the Nasdaq, and the S&P 500 to all drop right now as I'm speaking. Right, so they're all. It's been about almost an hour, and we're seeing some selling pressure in the equity markets and the bond market, and that's because of the Michigan numbers. So again, you had Michigan 1-year inflation come in higher than expected, 4.3% versus 3.3%. The Michigan 5-year inflation expectations came at 3.3% versus 3.2%. The consumer, so those two are inflation metrics that came out higher, basically signaling to you that another inflation metric that came out today, coming out hotter than expected, which markets don't like, stocks and bonds, they don't like that. And the consumer expectation and the sentiment from the consumers, the survey report is showing weakness there as well. So weakness in the sentiment of the consumer, but most importantly, why the market's dropping right now is because of that inflation number. So very interesting, because what we want to look forward to now after getting this report is the incoming CPI, the incoming PPI, all the inflation metrics now, because this is starting off to show you that inflation's somewhat sticking around and ticking higher, and we know the Fed is on pause, and this just gives more reason for the Fed to continue being on pause for a very, very long time, strengthening the dollar while, this basically strengthens the dollar while the other currencies out there weaken further due to their own growth metrics and due to their own central banks sounding way more dovish than the Fed, right? So that is putting a hawkish tone on the markets right now. And also, let's not forget, heading into the weekend, we got to hear what Trump has to say when it comes to those European tariffs, right? Are we going to get that? China, we know what's going on. I thought you had talks on Monday. Looks like that was canceled. And then it was talked about that, they're going to talk on Tuesday, Wednesday. Trump came out and says, I'm not in a rush to speak with China. They want to put tariffs, let them put tariffs. So we'll see what Trump has to say with Chinese tariffs also. So, markets are on hold. They are watching what's going on and trying to figure out where things are heading towards, right? So that is also another thing to watch out for over the weekend. So overall, jobs numbers, not bad, but the inflation story is now picking up again, and that is starting to be worrisome. And for the Canadian markets, current numbers for the job market is not bad, but do you trust it, right? Do you trust it? Because you always got revisions, and and the last revisions was massively different, right? Basically telling you what a weak market and how off they were in calculating these numbers. So anyways, let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified of the next video, and I'll see you guys around. Cheers, bye.